You think elections decide who runs America? You think the Federal Reserve prints money and Congress spends it? You think shareholders own the companies you buy from every day? What if I told you almost none of that is true anymore? What if the real owners of America don't live in Washington, don't run for office, and have never appeared on your ballot? They don't need to. They already own the debt, the land, the stocks, the votes in the boardroom, and increasingly the politicians themselves. And most of them work out of nondescript office parks in Greenwich, Connecticut, and Midtown Manhattan. They're called hedge funds. And over the last 30 years, they have quietly become the most powerful political force most Americans have never heard of. Stay until the end, because the third takeaway will make you question every headline you read in 2025 and beyond. How hedge funds quietly control America. 1 o'clock, Section 1. Origins, the birth of asymmetric power, 1890s, 1990s. Narrator calm, but intense. To understand how we got here, we have to go back to a man almost no one remembers. Alfred Winslow Jones. 1949. Post-war Australia is booming, but Jones, a journalist and sociologist, notices something strange. Mutual funds only make money when stocks go up. He asks a simple question. Why can TA fund make money when stocks go down too? He invents the first hedged fund. Long positions in stocks he likes, short positions in stocks he hates, and massive leverage borrowed from Wall Street banks. The structure is genius because it's private. No SEC filings every quarter, no obligation to tell the public what he owns. By 1966, his fund is up 5,000%, while the Dow is up less than 50%. Warren Buffett calls it an unfair game. But here's the twist no one saw coming.
Oh.
Because hedge funds are sold only to accredited investors, regulators basically look the other way. That single exemption written into the 1933 Securities Act becomes the seed that grows into $1 trillion shadow government. 1968, 140. Hedge funds, 1980s. Reagan deregulates banks, gives cheap leverage. 1990s. Long-term capital management LTCM runs $5 billion into $1.25 trillion in derivatives exposure with 2 Nobel Prize winners on the team. For 10, Section 2. The rise from casino to control 1998 to 2008 narrator, 1998. LTCM blows up. A single hedge fund almost takes down the entire global financial system. The New York Fed forces 14 banks to bail it out with $3.6 billion. You'd think Washington would clamp down. Instead, they do the opposite. 2000. Congress passes the Commodity Futures Modernization Act, basically legalizing unlimited derivatives gambling. Phil Gramm, the senator who pushes it, joins UBS's board 6 weeks later. By 2007, the 5 largest hedge funds control more assets than the GDP of France. They're no longer just betting on stocks. They're buying distressed mortgages, packaging them, shorting them, and insuring them with credit default swaps. When the music stops in 2008, taxpayers lose $700 billion in TARP money. But the hedge funds that shorted the housing market, Paulson & Co., Citadel, Magnetar, make $30 billion in a single year. The crisis becomes the greatest wealth transfer in human history, from the middle class to a few thousand hedge fund partners. After 2008, something changes. Hedge funds realize owning debt is powerful, but owning equity is permanent. Enter the activist hedge fund. Bill Ackman, Dan Loeb, Carl Icahn, Nelson Peltz. They take 5 to 10% stakes in public companies, threaten proxy fights, force layoffs, stock buybacks, and spin-offs, all engineered to spike the share price for 12 to 24 months so they can exit rich. Apple, DuPont, Procter & Gamble, even entire railroad companies bend the knee. A 2016 Harvard study finds that when an activist hedge fund shows up, long-term investment in R&D drops 50% within 3 years. But the stock pops, the CEO gets fired or paid off, and the hedge fund leaves with 300 to 500% returns. By 2015, the activist industry controls $200 billion and can decapitate any Fortune 500 CEO who refuses to play ball. But the real power move comes next, and most people missed it. Hedge funds start buying houses. Invitation homes created by Blackstone, technically private equity, but using the same leverage playbook. buys 80,000 foreclosed homes after 2008, turns them into rentals, and takes the company public in 2017. American Homes for Rent, Pretium Partners, Progress Residential follow. By 2023, the 10 largest corporate landlords own almost 1 million single-family homes. In some Sunbelt cities, 25 to 40% of all rental houses are owned by hedge fund-backed entities. Rents go up 30 to 60% in 5 years, while wages stagnate. BlackRock, Vanguard, and hedge fund giants now own 20 to 30% of every S&P 500 company through passive index funds and direct stakes. They vote your 401k shares, and they almost always vote for higher debt, buybacks, and layoffs. Because that maximizes short-term total return, you'd think Washington would do something. 2010, Dodd-Frank creates the Financial Stability Oversight Council to monitor systemic risk. Result? 0 major hedge funds designated systemically important until this day. 2020, GameStop. Retail traders expose how Citadel and other market makers pay Robinhood for order flow and front-run customers. SEC fines Citadel $22 million, less than 1 week of profits. 2021, Archegos Capital Management blows up $30 billion in hidden derivatives positions. Banks lose $10 billion. No one goes to jail. Bill Wong gets a civil fine. The pattern is always the same. Catastrophic risk gives public bailout or loss absorption, gives mild risk slap, gives bigger funds next cycle. Fast forward to today, the hedge fund complex now controls roughly $6 trillion in gross assets when you include leverage. That's larger than the GDP of Japan and Germany combined. 2024, hedge funds and private equity owned 40% of all U.S. nursing homes, 25% of all hospitals, most veterinary chains, and even the majority of local newspapers through Alden Global Capital. They own the companies that employ your doctor, fix your dog, and tell you what's happening in your town and politically. The industry spent $480 million on lobbying and campaign contributions in the 2024 cycle alone. More than Big Oil and Big Pharma combined, Citadel's Ken Griffin personally donated $120 million. Mostly to Republicans, but plenty to moderate Democrats too. Why both sides? Because the game isn't left versus right. It's upstairs versus downstairs. Hedge funds are no longer just investors. They are a new form of unelected, unaccountable political power that operates through debt, equity, and regulatory capture. Every major trend hurting the middle class, housing unaffordability, stock buybacks over wages, private equity, gutting of local news and healthcare, traces back to the same incentive: maximize short-term cash flow for leveraged funds. The system is now built to protect the funds, not the public. The 2008 bailouts were not a bug, eh? They were the feature that proved the funds are too big to fail, and they've only gotten bigger since. Here's the scariest part. We are probably past the point of gentle reform. The same funds that own your mortgage, your 401k, your landlord, and your hospital also finance both political parties and employ half the regulators who are supposed to police them. The question is, no longer can we fix this. The question is, what happens when the next crisis hits and there is no more public money left to save them, but they're still too powerful to let collapse? Who do you think wins that fight?